Okay, hi, my name's Graham. I'm one of the tax team here at Robson Laidler. They're my other members of the tax team. We didn't get the memo, but we're all dressed in black. Don't know why that is. But thanks for joining us today. We're going to go through the budget, which we've kind of subtitled The Good, the Bad and the Ugly. That might be a description of the presenters here. We've got 3 presenters. I'll leave you to decide whether that's true or not. But we kind of use that as a theme really, because I think that summarises a lot of what was in the budget last Wednesday. Some good, you might think otherwise, but we'll talk about that. Some bad, definitely some bad, and definitely some ugly. So in terms of the budget headlines, there was a lot of obviously speculation about what might happen. In fact, I would say that not everything that could have gone wrong went wrong in terms of the budget, and these were the main headlines. So, and this is what we're really going to talk about today. Not all of this, but 40 billion tax increases. This was a budget which raised the biggest tax raises since Norman Lamont's budget in 1993. Also, £30 billion worth of borrowing per year, and 70 tax and spending announcements. We're going to go through all 70, obviously. That was but yeah, we're not going to go through all of them. Significant increases in employers' national insurance, inheritance tax, amendments to include pension pots and restrictions on what's called business property relief and agricultural property relief. Headline rate of capital gains tax has gone up now to 24%, and additional stamp duty, land tax on second homes and non-dom status abolished. So we talked about, or we heard about a 20 billion black hole that needed filled in. It then went to 40 billion, and these are the 5 measures which kind of are to fill that black hole in sort of descending order. So employers NI is going to get the biggest return in terms of impact on the exchequer. That's like 25 billion. Then next is the abolition of the non-dom, the CGD increases, the VAT on private school fees, and the 5th one, which kind of is a little bit under the radar, but which is in terms of the impact assessments which are announced on budget day. That's going to bring in significant money, and it's 5,000 more compliance officers and 1,800 more debt recovery staff at HMRC. So you can see where some of the sort of focus from HMRC is going to be in the next 5 years. Whether that's a waste of money, I'll let you pontificate on that maybe. So I'm talking about what the good of the budget is, and you know, if you're like me on a high cultural plane, you might remember a show called Bullseye, where Jim Bowen would say at the end when the contestants had failed to win the prize, let's see what you could have won. I'm just flipping that around to see, let's have a look at what you could have lost and you didn't lose. Okay, so internally we did a little bit of a prediction exercise where we said, read all the speculation. We came up with 16 things which we thought might change in the budget. Do you want to have a guess how many we actually got right? 5. So don't take any tips from us on the 2:30 at Kempton. But these are the things which you could have lost, okay, which we thought might happen. So ERS NI on salary sacrifice arrangements, or employers NI on pension contributions, that's still there. The removal or the partial exemption of the pension tax-free lump sum, that's still there. Tax relief on pension contributions we thought might be restricted, you know, so at the minute you can get top rate of income tax relief on pension contributions, that remains. We thought there might be an extension of inheritance tax on the lifetime gifts. So instead of pets, you got charged IHT on giving stuff away during your lifetime. That is still there. The abolition of the HIT residential nil rate band, which increases your exemption from IHT, that's still there. We thought there might be some fundamental changes to the principles of IHT in terms of kind of trusts. So trusts pay a low rate of IHT, maximum of like 6% every 10 years. We thought that might change. It's still there. There was talk about restricting ISA pot limits. That didn't happen. And then the other one was dividend tax rate. We thought that something might change on that. And again, that didn't happen. So see, all that good stuff is still there for us to take advantage of. What we think is ugly is the ERS-NI rates. So from April next year, the rate's going to increase from 13.8 to 15%. And tied in with that is the threshold at which businesses start paying ERS-NI goes down from £9,100 to £5,000 per employee. Okay, so we'll look at how those two combine in a minute. The sort of good bit of it, if you want to put it that way, is that the employment allowance has increased from 5k to 10,500. So the employment allowance is basically a reduction of your ERS-NI, and that used to be 5k, and now it's gone up to 10,000 for all companies. And then for personal companies, and you know, a lot of our clients, owner-managed businesses, look at remuneration. What's the most tax-effective way to extract profit? And this just adds a little bit more complication into that calculation. I'll talk about that a little bit later. So, did some number crunching over the weekend. Sad existence. But anyways, what we're looking at here is basically number of employees who are aged over 21 who will then get paid a national minimum wage increase from April 25, working a 40-hour week. It's quite specific, I get that, but I just wanted to illustrate the impact of it. So you can see there that actually if you're what we call a business that employs, you know, a relatively few number of staff, so in this instance 5 people, a national minimum wage, your current ERS-NIC bill is about 6k, you'll actually pay less NI after April 25, okay? If you've got I would say between sort of 1 and 5 employees, you're probably going to pay less NI than you would have under the old regime. But you can see as the more employees you get, the bigger that the increased ERS-NI bill goes up, okay? So you get to a stage where if you've got 250 employees, your ERS-NI bill is going to be 34% bigger than what it was before April 25. So, you know, for instance, I think for us, we had a quick calculation. We employ about 100 people. Our ERS-NI bill is going to go up by about £75,000 a year from April 25. That's obviously going to have an impact on your sort of strategy going forward. You know, what we're going to do, it's an increase in an overhead, a 27% increase in that particular overhead. Like all businesses, what you're going to do with that? Pass the cost on to the customer, restrict pay rises, not take people on. So that's why I've classed that as a kind this ERS-NI increase is ugly in terms of for our type of business anyway. Profit extraction, I'm going to touch on that. So basically, a question that we get asked a lot is what is the best way to take money out of your company? Is it by salary or is it by dividend? There's no sort of definitive answer on that. You have to do calculations bespoke to each person's and company's sort of circumstances. But generally, we would advise that where you have your basic rate band available, so that's your first 50k's worth of income, you'll always be better off paying yourself a dividend with a low salary rather than paying it all by salary. And that's just because basically of the NI and also the low rate for basic rate on dividends, okay? and again, doing some modelling, you can save somewhere between 600 quid a year and £6,000 a year. But again, it depends upon the level of remuneration that you're taking from the company, and also depends upon, importantly, what the tax rate the company pays its tax on its profits. Okay. So again, just doing some modelling with the new ERS&I stuff, it looks to be that it increases this differential, i.e. it's beneficial to take dividend, small salary, but it's only a modest difference. Okay, it's not going to change your overall way of thinking or your overall planning. You're better off by hundreds of quids rather than thousands of pounds. Okay, but like I say, there's no rule of thumb with it. You have to just do the calculations, bespoke calculations, depending on circumstances. If I'm an owner manager, what do I pay myself? So this is the low salary dividend route. Okay, you've got various options. You can pay yourself £5,000 salary per year. In there, you'll have no employer's national insurance, but the downside is you won't have any stamp for your national insurance. Okay, so it won't be a qualifying year for getting your stamp for NI. You could pay yourself 6,500, which is the lower limit for qualifying for your stamp. Yeah, and you'll have a little small national insurance employer's liability of 225 quid. Or you can pay yourself 12,570, which is equal to the personal allowance, so there's no tax on that, and you'll pay £1,100 of ERS national insurance. Okay, so you've got that choice. You probably don't want to do the first one because you get it's not a qualifying year for your national insurance stamp. Again, I did some numbers, say looking at a cost comparison. If you were looking at somebody getting paid 30k salary, let's look at a mix of a low salary and dividend, and which one do you think out of those three would give you the biggest take home? So what we're looking at is the overall tax cost of the company and the overall tax cost of the individual. Would I pay myself 5, 6.5 or 12.5? Anybody would like to guess? 12.5, okay? Just because basically that salary plus the ERS&I gets a deduction for corporation tax. Yeah. But as I say, it's about needing to crunch the numbers. It's very, very dependent upon what rate of tax your company pays. Okay? And on that, basically 12.5, you're going to be 470 quid better off or £1,000 better off. Again, not majorly different from the other options, but still better. Okay? Capital gains tax, we've put this as bad, but not as bad as we thought it might have been. So there's quite a bit of talk about equalising capital gains tax rates with income tax rates. That didn't happen. That means that we'll always still be looking at extracting monies by way of capital rather than income, because we've still got a highest rate of 24 compared to a highest rate of income tax of 45 plus if you're in certain circumstances. Okay, so the basic rate goes from 10 to 18 from the 30th of October, and the higher rate goes from 20 to 24 again from that date. Okay, so that's the date of the budget. No changes to residential property rates, and the rates applicable for trusts and personal representatives, that's somebody's dealing with an estate, increased from 20 to 24 again from that same date. All right. Changes to business asset disposal relief. So again, could have been worse, but the lifetime limit remains at £1 million. But then the 10% goes up to 14% from 6th of April 25, and the 14% goes back up to 18% from April 26 a year later. Okay, I think this has got a limited shelf life. Personally, I think this might go by the end of this government. But if we do again the numbers, let's have a look at what my capital gains tax bill would be, ignoring the £3,000 annual exemption. If you sold your business, so that's if you sold your company shares or your business which qualified for business asset disposal relief. So you can see that it depends upon when you do it. There's various, obviously we've missed the boat on this one, although we do have some clients who did some stuff before the 30th, when the regime was as it was. You've still got an option. If you're only going to get £1 million, your tax bill ain't going to change. Yeah, if you do something before the 5th of April next year, it will change where you get above the £1 million. So I'm not going to go through, hopefully you can see that, and we can probably share these slides with you later. But you can see that the rates will go up, but I would say, so the rates go up from 10% to 18% on $1 million, and on 10 million from 19% to 23.4% on 10 million. I think that's still a pretty good rate of tax. Yeah. Okay. And now I'm going to pass it over to my colleague Martin, who's going to talk us through some property tax IHT stuff.
Thanks, Graham. So I'm a little bit younger than Graham, so I've only seen Bullseye on YouTube. It is still available on there. I think it might be making a comeback, actually. The source is that? Yeah. Very important question. Who thinks it should come back? So, yeah. We've put this as good, but to be fair, you might think if you're buying property, the main two changes for property people were ignoring whether it's a property used in a business or a farm, but you've got additional SDLT if you buy another rental or you buy a rental within a company. So you might wonder why that's good. And I think just going back to the starting point from Graham's point, there was a lot of talk about what could have changed for landlords because, of course, landlords are often vilified, probably only vilified more than traffic wardens in society. Of course, business owners aren't exactly loved either often, but so it could have been a lot worse. What we did get, though, is an increase in, so when you say non-natural person here, it normally just means company, but the legislation uses this term non-natural. It's not a slur on landlords in particular. But we're seeing an increase from 3 to 5%. We do have a couple of solicitors in the room who we can pull up if we need to. They're looking terrified. But yeah, so normally if you exchanged contracts on a sale before the budget day, the buyer will probably still get the old rate. What does this mean? Well, it means sophisticated landlords and buyers will just budget into their offering price this 2% increase. Gentleman agrees there, thank you. So yeah, if you were going to offer 200 for something, you've got, what's that, £4,000 difference you can now offer. If you're buying property, it's normally a long-term plan, so a couple of grand over 20 years isn't normally a massive thing. We've also got changes to ATED. So ATED is largely if you've got a home sitting within a company. It's something that doesn't apply to a lot of people, but if you've got a property in a company that isn't rented out, you have really high rates of stamp duty on ATEDs. That's gone from 15% to 17%. It's also an annual charge on those properties as well. You'll normally know if you've got one, and I certainly know in the RL team we've looked across our client base, and we normally try and reach out if we think you have this problem. So it doesn't really apply to many people that we see. As I say, there were transitional rules for people who would exchange before the 31st of October, who complete after. Stamp duty has this term substantially performed. So normally if you've fully paid for it and got the keys, you've essentially done the deal even if it hasn't completed. But if you're in that position, I'm sure your solicitor will take you through and let you know what it is. What went recently but has still gone is there was an option if you bought more than 6 residential properties, there was an option to treat that as commercial. That no longer exists. That went last budget. So just to make sure you know that. And there was a bit of doubt, but Jeremy Hunt's last budget, he said they were going to cancel the rules for furnished holiday lets. There was a bit of ambiguity as to whether that was going to be carried on and done by Labour. That is still happening. So at the moment, there are some slightly more beneficial rules for holiday let owners over normal residential landlord owners. Those rules are going in April 25, which is what we thought. on the things that we should be thankful for, I suppose, is there isn't going to be national insurance on rental income. That's been floated on and off over the years. And ironically, as part of the debate, if you are a landlord, you'll have seen, well, if you're anyone, you'll have seen the debate about what's a worker. You know, no one seemed to be able to tell what a worker was. So landlords were frantically trying to prove they were workers, but they don't realise that to get that, you'd have to argue earned income, which is normally liable to NI. So you've got to be careful what you wish for, but it's unchanged. Nothing happened. It doesn't come up again, but I'll just float you out. One of the questions I get all the time is, I'm buying a residential property to rent out. Should I buy it as an individual or through a company? A bit like there's no simple rule of thumb on how to take your money out of a company. There's no single answer. There's no simple answer to whether you should buy it as an individual or through a company. You have to look at the detail every time. If you're not looking at the detail, you're probably missing something. So we do a lot of that work. And I'm probably going to pull together a separate webinar on that I'll put out there for people. Inheritance tax, you know, again, what could have happened and what has happened? Well, the rates are frozen. So you'd have seen that. We still have the residential nil rate band of 175, which is fairly good. There was an option, there was talk that might go. To be fair, if all the things that were floated all happened, it would have been carnage. So I think they were probably just testing the market to see what went down well. But the bands are all frozen. So in inflationary times, your asset values are going up. And to have a threshold that doesn't remove, that is a tax by stealth, really. But to be fair, the rates haven't changed in a long time. So that's not a Labour thing, that is a government thing. You still have the abatement that happens once your value gets over 2 million. So you don't get the residential nil rate band if you've got a big estate. I think the numbers on IHT and who pays it are relatively small. It's less than 10%. But the longer that the thresholds freeze and the more your assets go up in value, that will, of course, increase the number of people that are within that charge. Amanda's going to talk about pension pots soon. Hopefully she's getting the microphone. It's all sorted yet. Obviously, you know, pension pots have been part of IHT planning. Or I would rather say the tax relief on pension pots has been part of the attraction to pensions. And I'm sure Amanda will talk about the types of things you still need to think about. And, you know, there's a change here for trusts, which, again, doesn't affect that many people. If you've got a trust, you're involved in any way in a trust, reach out to the team, we'll sort you out and let you know what you need to know there, and if it affects you. So, what's interesting on IHT, though, is the business property relief and agricultural property relief. So these really, I feel like these reliefs are very similar in design and intention to the fact that you can sell your main residence tax-free. If you sell your house and you had to pay tax, you'd have to downsize every time you moved house. You don't have to because that sale is tax-free. I would have to go back probably 60 years to see the original intention on these reliefs. But the main point of them is to be able to pass on a trading business or a working farm to your next generation without losing a slug of tax. So farmer passes away, the whole estate would go down, no tax would be paid at that point. It's nice and simple. There are limits coming in which basically essentially mean that there's going to be an effective 20% tax rate. Where does that effective 20% come from? It's 40% on 50% of the estate. So half of 40 is 20. And what it means really is that for some estates, although still probably quite a relatively small number of estates, there will be more tax. I think this will affect more business owners than farmers, to be fair, because there aren't surprisingly that many farms that are worth multi-millions. There are still a lot of people affected, but certainly businesses have unlimited upside value, whereas farms are normally based on a price of an acre for a farmland. So it's quite hard to accumulate, you know, a £50 million farm. What you've got here, though, is I think a lot of the, whilst I think this is a bad move, I think a lot of the talk I'm seeing around at the moment in the press and people complain about it misses the fact that you still have a lot of reliefs you can use during life to pass on trading assets. So what you might see here is I don't know if anyone else uses this term, but the idea of dying with your boots on. So if you still own the business when you die, you are working still as a working owner. That's where the IHT reliefs came in, but there are still lifetime transfer reliefs to avoid capital gains tax on gift. And if you don't die with the asset in your estate, there will be no inheritance tax as long as you do it early enough in life. So instead of a 90-year-old business owner or farm owner dying at 90 and leaving it in their will, give it away at 60 or 70 to the next generation when they're in their 30s to 40s. I know that fundamentally changes the dynamic of where the income goes, etc., but it is still possible to pass on family business and farms. It's just in a different way. So rather than just kind of hoping you can keep a hold of it till you die, you probably need to plan a little bit earlier. You might need to start trusting your relatives a bit more and giving it away a bit earlier, which I know is probably the bigger challenge there, not the tax. So if you can figure out who you trust, we can help you get it to them. Let's just say that. There are some other changes on this. Again, APR, it's not a massive thing used by many people, but there are some other changes on there worth a mention for those that are relevant. Again, I think we can just share these slides with anyone who's here today, so long as you're registered. I think some of you haven't registered looking at the numbers, but we can get the slides here. That's easy enough. What do you need to do then? So again, these changes are coming in from 26. Gifts, you can just give away. We jokingly talked about whether we should put death on there. If you think you're going to die before April 26 without being morbid, then you don't have to worry. But that's probably not good planning. Again, that's probably slightly worse than giving your stuff to your kids. But you know, there are things you can do before the rules come in. And like I say, there are still exemptions for passing on business assets. Thank you. Which you should really be looking at. So if you've got an estate with a business asset or a farm asset worth anything over £1 million, you should definitely have an active planning to make sure you work out what you can do based on what your future plans are. And it says on there the lifetime transfers will apply from 30th of October. So there's a whole load of information that we don't quite know here. So you might have given away your business or your farm a year ago based on the rules at the time, and you might die after the new charge comes in. We haven't quite got to the bottom of the detail on that, and we don't know whether it's categorically just gifts from the budget or whether it's all previous gifts as well, because there were already conditions you had to satisfy on death based on old gifts. They're quite complex, and we haven't got to the bottom of that. The detail isn't really there yet, but when we get it, we'll share it, of course. And if you've got trusts, there are questions to be answered about whether you should be breaking the trust, taking assets out because of the changes in the way the trusts are going to work. So again, one thing that didn't happen is the headline rate of CT didn't change. That was something that was mooted. And certainly if you look at the wider conversation, I think if you look at, you know, depends where you look, but if you look to our west, it would be, you've got the US that still has generally lower spend and lower taxes, and the EU has higher spend, higher taxes, and we're still kind of between those two. I'll let you decide which model you would rather be, but we're definitely like in the middle of those. And this shift has pushed us more towards the European model of higher spend, higher public sector, and more taxes. What we still have though is the headline rate to remain at 25. Again, there's different rates as you go through the bands to get there, but larger businesses pay 25%. There's been no change in most of these things. There has been an announcement they're going to monitor international developments to ensure that the UK remains competitive. We still have full expensing on spend, so you haven't got to be as old as Graham's bullseye days, but we used to get capital allowances on spend. The relief was spread over the life of the asset. There was a change to full expensing, so if you buy, you get the relief in the year of purchase. That is unchanged. And there's been no change to the £1 million annual investment allowance. And to be fair, other than there's going to be consultation on transfer price and permanent establishments and diverted profits tax, which are all basically about where profits are taxed within groups. So if you've got offshore groups and onshore groups where the profits are taxed, there's going to be consultation on that. There probably isn't a great deal you need to know about if corporation tax was your main issue. one thing that's been a bit up in the air, and I would say, you know, probably a lot of farmers have double cabs, but the benefits in kind on the use of a double cab was fairly generous. There was then a case that decided that we didn't think they were really vans. And where we are now really is we've got this transactional period. If you want a company van that is a double cab, so that is literally 2 lots of seats with a flat pack, if you get it before 5th of April 25, you'll get the current reasonably generous rules. That is going. So if you've got a genuine need for a double cab as your company van, you will be worse off probably your next van after this one.
Excuse me, is that referring to vans as well, or just
Double cabs, just double cabs. So if you get a transit van or a, I don't know, I can't name any of the vans, but yeah, if you get a transit van, I normally can, I know me vans, but I just can't think of any now. But if you get a Sprinter or like a proper van, vans are okay. This is double cabs in particular.
What about the vans with the seats?
I think vans are still vans. Although there was a case, there was a Coca-Cola case. Any of the team want a microphone here? No, we'll pick this up. There was a weird case where some Coca-Cola vans weren't treated as vans because they had the wrong seating configuration. I don't know where that settled, but if you've got a normal van, you're probably all right. Yeah, if the intention is to carry a ton weight on the back axle, it's probably still a van. There's a bit of ambiguity. We're happy to sort that out afterwards if you want. I think the reason why they were probably keen to sort this out is a lot of company directors were saying, well, I need a vehicle, I'll get a van, but don't really need a van. So you've got people who've literally never put anything in the back of a flatbed van other than their weekly shop, which wasn't really the intention on the van. Graham, do you know people who do that, Graham? Is that why you're smirking? So yeah. What else is going on? They're going to charge more on outstanding debts. So if you owe the Inland Revenue money, to be fair, not like you should ever purposely not pay the revenue, but the rates used to be quite low when we were in a low base rate environment with relatively low charges. We're up to the point where it's 9% interest on if you owe the revenue money. So that is now more of a deterrent. There's been an extension of EIS and VCT through to 2035. If you don't know what they are, they're basically, if you're seeking investors, you can find there are ways to make the investment in your business more tax efficient for the investor. If that's something you're looking to do, we can help you with that. Sneakily in there and unchanged is the fact that making tax digital is still coming in. So this doesn't affect companies at the moment, but if you're a sole trader or a landlord with over 50k of turnover, not profit, turnover, then you'll have to do quarterly updates from April 26. From April 27, if your turnover is over 30, you'll have to do quarterly updates. And what they've now said, which is new, by the end of the life of this Parliament, I don't know if they're setting you as a challenge there to end the Parliament, but by 5 years from now, they're anticipating that threshold will be down to £20,000. So I think with my simple maths, with a bit of inflation in there, that'll be anyone with 2 or more properties and most, if not all, businesses. I think if you're a hobbyist, you'll probably still be under 20. But if you're doing something as your main activity, this is going to be basically all sole traders, I would say. Payrolling of benefits is still going ahead, and if you don't know about this, again, our payroll team will happily talk about this, but the days of just declaring once a year on a P11D that there's a company van and healthcare, they're going. You will need to payroll benefits from April 26. There are some exemptions and things to know about, but again, the way of reporting benefits in kind is changing. Over to Amanda for pensions, please, Amanda. He's the same. Yeah, I mean, it's still up in the air because of the approach of the Inland Revenue that they basically launched inquiries into most people that have done anything. But yeah, Jack can speak to you on that if you want to. All the team. Yeah, it's been enough change, but no changes today.
Okay, hi. I'm just going to speak really briefly about pensions because you probably all just start to glaze over when you see the word pension. I'm Amanda Cowie. I'm a director and chartered financial planner at Robson, Laidler Wealth. We're a sister company of Robson, Laidler, and we look after about 200 to 300 families and their wealth. So this budget has been quite hotly anticipated by us and our clients. And to be honest, I've never seen as many rumours around financial planning and taxation as I have in the last 2 months. And I suppose it depends what newspaper you read or whatever, who you talk to. There's been like a different rumour every day, which is quite anxiety inducing for people when they're trying to plan ahead, particularly for life post work and that sort of thing. So I suppose a lot of the things, we're talking about the good, a lot of things that we might have expected didn't happen, so that was good. Things like, as been said, you know, the abolishing higher rate and additional rate tax relief and bringing in this flat rate for contributions. So it's still really good to get to pay into your pension and get that tax relief on the contribution. So that's still good. We're really pleased that they didn't do anything about that. We suspect it was to do with public sector. This budget has been quite public sector focused. And if you're a doctor, a highly paid doctor, you've just received a 5.5% pay rise, which is very nice. And then 2 months later, you look at your pay slip, and if the tax relief had been limited on your contribution, you probably would have found that you had a pay cut. So that probably wouldn't have gone down too well. Similarly, things like the tax-free cash allowance, we thought they were going to abolish that. They might still reduce that a bit actually, but that would have affected a lot of public sector workers. And if you are a doctor that's worked for 35 years, expecting a lovely big tax-free cash lump sum, you know, and then the rug is pulled from under you at the last minute, you're probably not going to be best pleased. So again, we were pleased about that. The tax-free cash limit is still 268,000. That's still quite a lot of, you know, incentive to save into pensions. So that was a good thing. The bad thing really for us as wealth planners, as helping people plan ahead, was basically the IHT bit, really. And a lot of our clients are business owners, they sell their businesses, and for many years they've been saving alongside, you know, they've been saving into pensions, getting lovely tax relief, corporation tax relief on the contributions, which is still there, which is great. Growing their pots outside their business. They sell their business, and then basically the plan was to spend down those inheritance tax unfriendly assets, those savings, those investments derived from the proceeds of their business, and then pass on the wealth in their pensions to their families. And from 2015, it's been freely available to do that. So of course, that's been our message to clients. So do we just throw everything out? So no, we don't. Probably what we'll do is tweak how people take an income in retirement. And I've just sort of doing the numbers. And if you've got a large pension pot, which many of our clients do have, it's still possible to take 67,500 a year as income from that pension and only pay tax at a marginal rate of 11% on that money. So that's still really valuable, we would say. And also, you can still use your pension if you're married or in a civil partnership. You can actually pass that inheritance tax free to your partner when you die, being a little bit morbid. And one client phoned up the other day and said, "Oh, I suppose I'm going to have to marry my partner," and because of this, actually. And I said, "Well, you know, it has been done before many times, not particularly very romantic, but you know, whatever." So that is still available to you. You can pass inheritance tax-free to each other if you're in that kind of relationship. So again, still good for pensions. I think, yep, it's probably going to take a while to get this through, a couple of years just to sort of, you know, run it through the system. A lot of things will have to change. Yeah, go on.
Can I just repeat, so if it's your pension is going from spouse to spouse, it's tax-free still?
Mm-hmm. Yeah. Yeah.
Maybe yesterday that was changing, but it's definitely not.
No, and actually another anomaly on that, which is an interesting one, which they didn't change, which I was surprised about, was, I don't know if anybody knows this, but if you've got a pension, as long as you die before you hit the age of 75, you know, maybe not even 2 days after your 75th birthday, you can pass a lump sum tax-free on So it's almost like a life policy actually, but it seems a bit daft because if you've been taking an income from that pension for say 15 years post-retirement and then you die age 74, you've been paying tax on some of that income from your pension, and then suddenly, now that you're not here, it can go to somebody else and they can draw a tax-free, they can get everything tax-free. They didn't change that, which we think is a bit strange. It's very weird, isn't it? I know. Yeah, did you not know that? Yeah, I know. So you can still do that, but we wonder if that will change in future.
Spouse to spouse, not spouse to children.
No, that's right. I think the inheritance tax element will have changed that as well, because obviously if they bring it into the inheritance tax regime, it makes more sense to pass it to your spouse first and for your spouse to spend it. So I think I think the message really is probably quite easy to do. I know. You should hear some of the conversations I have about that, actually what they put in people's tea at night and things. Anyway, so the message really is, actually pensions are still a really good part of your financial plan, but actually as part of an overall financial plan. We use loads and loads of different tax wrappers, as you call them. A pension is one, a stocks and shares ISA is another, because basically what we all want is to enjoy the same life post-work as we do in work, and actually using different resources to achieve that and to pull income from different pots in a very tax-efficient manner. And that's really why you work with a planner, to help you do that, unless you want to do it yourself. But that would be the message, that pensions are still valuable in that respect, but we might need to move the income from them slightly forward. I think that's the message. So if you want to speak to me at the end, happy to have a chat. I hope that's okay. Okay. Oh, gone the wrong way, sorry. So that was another one. Yeah, so if you get to 75 or pre-75, there's the possibility you might want to even take out the tax-free cash at that point and you could gift it. So that would be another way of doing it. Or, as I've said, you could draw an income of up to 67,500 and then reduce your tax and use the tax-free cash and spread it over the life of your pension. There's lots of different ways you can do that flexibly. But yeah, it's just going to take a bit more tweaking and a bit more advice, really.